Good morning, everyone. This is Marshall Giller bringing you the morning comment for October 14th. Well, as I mentioned yesterday, Fed Vice Chair Stanley Fischer said over the weekend that if foreign growth is weaker than anticipated, the Fed might, quote, remove accommodation more slowly than otherwise, unquote. This seemed to me to be a perfectly normal thing to say, judging by the Gitler inversion rule. The Gitler inversion rule is, if a statement doesn't make any sense when it's turned around, then it's not particularly significant. However, the market clearly didn't see it that way at all. The implied interest rate on Fed funds futures collapsed, while at the long end, 30-year bonds broke below 3% for the first time since May last year. It's clear the market believes something has changed fundamentally. Inflation rates are falling, and both inflation expectations and interest rates are falling with them. Not only are market participants becoming worried about the inflation outlook, but also they're becoming worried about central banks' ability to do anything about it. That is probably the bigger concern. With policy rates already at zero and waning confidence in the efficacy of quantitative easing, investors are wondering what kind of material, if any, the global safety net is woven out of. The omnipotence of central banks is being questioned. Still, the market activity shows people aren't throwing in the towel completely quite yet. The fact that the growth-sensitive Swedish krona, Australian dollar, and New Zealand dollar were the best-performing G10 currencies up to this morning shows remarkable confidence in all things considered. The Swedish krona may have gained in anticipation of a higher inflation number out today, which, in the event, didn't materialize. In fact, inflation fell, or the inflation rate fell. The Antipodean currencies got a boost from the People's Bank of China, which cut its repo rate for the second time in less than a month. This wasn't part of Beijing's ongoing targeted easing measures, but rather just an attempt to ease the burden on small companies, I understand from press reports. So I'd expect the global stock market rout to be a more powerful influence on the Aussie and Kiwi, and I see a strong possibility that those currencies fall back again. We're still waiting for the ZEW survey for October. Both the current situation and expectations indices are forecast to have declined, which could hurt the euro. In a similar vein, Eurozone industrial production for August is estimated to have fallen 0.9% year-on-year, which is a sharp turnaround from plus 2.2% year-on-year in July. So that would increase the likelihood of a decline in Eurozone GDP for the third quarter. Also out today, the UK inflation rate's forecast to have slowed for a third consecutive month in September, which could scale back expectations for Bank of England tightening and encourage cable bears to take another run at the sub 1.6 figure territory. However, the UK employment data for August comes out on Wednesday, and average weekly earnings are forecast to have accelerated somewhat. An improvement in the employment data could change the picture. The only indicator coming out from the U.S. is NFIB small business optimism for September, which isn't particularly market affecting. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Giller, head of Global FX Strategy at IronFX Global, wishing you solid trading.